Hey everybody, it is Brian Shannon from Alphatrends.net. Happy New Year. It is Friday, the 1st of January, and let's take a look at what we have for last year. I'm not going to go into a whole big philosophical what we can do right this year or groups and predictions. I don't like to make predictions. I just like to take the market as far as what it gives us, and we'll take a look at that in a moment. Just let's look at these numbers though. The S&P 500 was down about 3/4 of a percentage point. Russell 2000 close to 6%, and oil really was the one that got creamed this year, down close to 46% after a huge loss last year as well. And the dollar index actually was up 7%, so that should be green, but the US dollar gained ground. And let's take a look at the charts and see if we can make some sense of it. Basically, this year, I think the official term for this market, the technical pattern, is a mess. We saw a lot of back and forth action above and below the volume weighted average price and where we had closed the year. So this is approximately the closing line for last year, and obviously we can see all the time that we spent above or below that line here with basically a pretty narrow range. If you really just, and you can't do it of course because it was real, but if you take that part of the market out, that month and a half, we really had a very narrow range this year. And that begs the question going into next year, is this distribution before a bigger decline, or did we see the shakeout in this market and that's good enough and now it's building energy for another move higher? My suspicion is that we're going to see a difficult year going forward, and we'll likely see lower prices. But we're here not to make predictions, but to say how can we take advantage. So when we look at the daily time frame, we can see that again we've got a mess here. Over the last month and a half, we had this high from the recovery, we had a lower high, another lower high, and this past week we had a lower high. We had this pullback low, we had a lower low, and another lower low. So we have to be a little suspicious up here and wonder, is this distribution before decline? Again, we're not here to make bets. We're here to look at the market logically from different viewpoints, that is time frames. Your job is to figure out which time frame makes most sense to you. My bias is always from an intermediate term standpoint, that is that of a swing trader, and those are the trends I like to put myself involved with when I talk about these markets. So even the last month, if you look at the month of December, just a terrible mess in here too. All these gaps back and forth, that made it very difficult to control risk on overnight positions from a traditional standpoint. And that tells us, possibly it makes me think, of course, of the George Soros saying that volatility peaks at turning points and diminishes with a trend. And here we're seeing a lot of volatility. We're not seeing a lot of order to this market. But going into next week, we can take a look and see what's been important. The volume weighted average price from this gap lower. And we have, of course, this has been an important level on numerous occasions over the last month. One is support on a couple occasions, and two also is resistance. So 203.5-ish we would like to see hold. If it's unable to hold that level, then it appears to me that we're most likely headed back down towards 200 again. So we have to look at this market with a lot of suspicion, basically, because we have distribution that's giving us intermediate term trouble here, and that says that going into the new year, nothing changes other than the calendar. Our job always remains the same: identify the low risk, high probability trades, and determine the time frame that we're comfortable engaging them on. And then depending on what we think the risk is overall for the market, such as a choppy environment right now, what do we commit in terms of capital? What's our position sizing? And whenever we have indecisive markets overall, where we have stocks going up and down, it tells us that we want to be involved in long stocks and in short stocks, and we want to manage risk based on really, I think, an intermediate term time frame, and look at each stock based on its own merits. Of course, there are times when the market overall has a bigger catalyst or something that it's trading behind, such as oil. Oil has been a leader for this market recently, but you can see that the downtrend has been severe this year in the USO. USO, the volume weighted average price up there, north of 16, and here we are at 11. There's no such thing as down too much just because we are down a lot. We came into this year, a lot of people thought oil was going to have a strong year because it was down too much in 2014, and that's obviously not the case. Down a lot doesn't mean anything. We still have a downtrend here, and there's a supply and demand equation out there that's being motivated by bigger factors. And so you can't just look for a market to bounce because it's down a lot. The NASDAQ for the last couple months has been stuck in this range that I've drawn here. You can see we're pretty much right back to the midpoint of that range. So if we take a look in here, you can see, we've been basically 109.5 up to 115 and change, and we are below the 50-day moving average. That 50-day moving average is going to start to decline. So, I'm not here to make predictions about which way this is going to break. If it breaks the high end of the range, then we would look for the possibility of continued upside, but being aware, of course, that breaking out doesn't mean that it's going to go. It means we can't just say no risk management. We say, hey, where does it come from? Where does it have the potential to go? If this market can, rally back up towards this level and then show a little bit higher low, and we buy a breakout, and if it comes back down and stops us out, then we get stopped out. It's that simple. If we see the market break down, do we want to sell it short immediately below 109.5? No, we'd rather see it do something like this, create a lower high, then break down, short it in here, and put a stop above the most recent relevant lower high, which would be right there at that point. So again, not predictions because we're in a range. Generally speaking, though, when we see a range-bound market, it tends to resolve itself in the direction of the bigger time frame trend, which of course in the NASDAQ is higher. That's what's typical. That's not what will happen. We don't know what will happen. Technical analysis is a tool that allows us to determine what our risk reward is, what our opportunity is, and if the opportunity is not revealing itself to us in a low risk setup way, then our best position is generally going to be cash. Cash allows us to say, okay, I'm going to focus on individual stocks because the market itself isn't providing clarity for me. And in those stocks, because we have a higher risk environment, I'm going to trade them with smaller share size. And that's exactly what I talk about every single day at Alphatrends. By the way, the webinar from last week was recorded, and I decided to put it on Alphatrends with this post. So if you're viewing this on YouTube and you want to watch that, what to learn from the losers, we went over probably 100 stocks in 10 different categories. And I think it's a really good lesson to look at these stocks and learn what to look for and recognize for 2016, because defense risk management is job number one. As they say, defense wins championships, and you have to have a strategy for that, especially if we do come into an environment where this ends up being distribution and the market breaks down, such as the Russell 2000 has. The Russell 2000 had a bad year. Now, when we look at this daily chart, what do we see here? We can see that, we've seen a little bit of a rally in here recently, but with it being trapped at the declining 50-day moving average, it's starting to look more like a bearish flag than anything. And we are seeing, right now that this little band of prior support is acting as resistance. We backed away strong from that Thursday, Friday, and here's the yearly chart. So looking at January, the volume weighted average price for the Russell 2000, you can see early on in the year it held as support and then as resistance. And we had, as we know, the failed breakout here in the the Russell 2000. And we spoke almost ad nauseum about that we didn't want to be a buyer because it was extended at that point. It wasn't just the fact of breaking out, it's how did it get to that point? And then it backed off real hard. So the Russell 2000 is looking the most ominous, really, in my opinion, of these bigger indexes, and this, has the potential of leading the rest of the market lower. So keep a close eye on the Russell 2000. It is below the 5-day moving average. To me, it's guilty till proven innocent. As long as it remains below 114.5 to 115.5, that the bias early into the new year is negative there. Semiconductors, we're in a big box here too, and this one is kind of, over the last 2 months, we're coming down into what's been the band of support in here. And again, this group we saw found resistance at the declining 50-day moving average on last Wednesday and Thursday, and first 2 days of last week. Anyways, we saw that, of course, on the day before the house. So that was Thursday. So Tuesday and Wednesday of last week, we found resistance at where we see the conjunction of the 20 and 50-day moving average. Looking to a bigger time frame, we've got a big mess in here. We saw this strong pullback followed by a very strong bounce, and now this is going to be our key level. That this is the band of support we want to see hold, and how it breaks through it is more important. That's if it breaks down slightly through it, the best scenario would be just a little bit of a rally and then a couple days later to break it for real. So that is often the way it works, but right now we have to be very cautious. We're stuck below a declining 50-day moving average, and we're below a declining 5-day moving average as well. The biotechs have tried earlier this week to break beyond that little band of resistance that we had been talking about, and we had low expectations for it because we've got a declining 150 and 200-day moving average. The volume weighted average price year to date, that is for 2015, you can see that's that purple line pretty much right here, meaning the average price the biotechs traded at was right here, despite the fact that they were up 11.5%. The average participant owns the IBB right at this level, meaning that we've had a big rally in here. Now, if this is distribution for these biotechs, we've certainly seen a very big run up, and to think it would pull back down to 250 in 2016 doesn't seem very unrealistic to me, not with this volatile group. So heading into the new year though, we kind of have a little bit more neutral than anything right now. We're stuck in this box here for the biotechs, and that's going to be the key range to break with vigor. And again, if it breaks it to the upside, we can't fully trust it with those longer term moving averages that are declining. Shares of Apple were down for the year, and that shouldn't be a surprise. I mean, most of the year we spoke about this stock being guilty till proven innocent and neutral at best, and maybe trying to recover, but it never recovered from breaking down. And once it was below that declining 50-day moving average, the stock has been guilty till proven innocent. And as I think I saw someone say, this is the first negative year for Apple since 2008. I don't know if that's true or not. It didn't confirm it. It's just another stock to trade. And heading into next year, we see that we broke below this little box here, and it looks like it's still headed lower. It's below a declining 5-day moving average, and it's going to need to get back above 109.5 just to become neutral. Now, in the webinar that I did, by the way, I made an offer for Alphatrends subscriptions. If you're interested in a subscription to Alphatrends, you'll know that if you've been following me for a while, I think the last time I did a sale price for a subscription was about 2 to 3 years ago. Anyways, the for annual gold subscriptions, which are normally $7.99 a year, until January 15th, it's going to be $599. So you save $200. Non-refundable. Make sure you know what you're getting involved in. If you're looking for a free trial, just go back and look at the archives. If you're listening to this, you're familiar with my work, and I keep a very consistent approach to the market. That's what you can expect. For a silver annual subscription, which is typically $599, the price has dropped to $449 for 12 months access. And for the bronze subscription, which just gives you the end of day updates, then that was typically just $249 a year. It's $199 now. I hope 2015 was a great year for everyone who listens here. Thanks for valuing my work. Thanks for tuning in, retweeting, sharing, whatever. I do appreciate it, and I hope that 2016 is a great year, not just in the market, but in every aspect of your life.